Thanks for that love. Now here comes some love back at you. Here we go. Yeah.
That is actually what we call a tax code. Okay, now anybody who's in insurance or who's done insurance or who's possibly gotten their license and listened to your upline for 30 seconds has probably heard these four magical numbers. Perhaps not the first part of it, but definitely the last four numbers, which is IRS Code 7702, the most commonly used tax code in insurance, which talks about the one thing that we want to talk about here, which is it actually makes the distributions from insurance policies tax-free, as we call it, tax-free with quotation marks. It's actually possible. So any death benefit distribution, any cash value withdrawals or loans, it's all ran through this entire code, and it talks specifically about how the distributions from an insurance policy are not taxable. There is another code following this one that I like to use a lot, and these are two codes that many people, well, generally speaking, don't fully understand. This is the IRS Code 535, and what that is, it talks about the accumulated taxable income within inside any sort of investment, generally speaking, or any sort of account that accrues interest over the course of time. And in this one, it'll show how the actual growth of a life insurance policy is tax deferred. Now, notice I didn't say tax-free.
I noticed that.
I didn't say tax-free because the growth inside of a policy isn't tax-free. It has to be taken out properly in order for it to be tax-free.
That's why a lot of people try this and it ends up messing up the client really bad.
Correct.
Gotcha.
Because so many agents are going around and saying, yeah, it's tax-free, it's tax-free, it's tax-free. But if you're dealing with this level of clientele, corporate insurance plans specifically, you can say the wrong thing. They can take the money out of the insurance policy and bam, it's all of a sudden taxable.
Understood. Understood. So I guess to make everything really clean, the first tax code we saw is why our insurance isn't taxed on the face amount and the cash value. And then the second one is just really going to it how it grows tax deferred, right?
Yes, it's one little category in this whole tax code. It's hundreds of pages long. I mean, it talks about all kinds of any kind of vehicle that grows. But that one specifically is got the piece of it that has the insurance side of it. Now, this is my favorite one, though. This is the one that I actually sat down and I read. And I realized that we can use this for a lot of different reasons. Actually, I'm very, very certain that, these higher level executives inside of these insurance companies, they know this code left and right, in and out. And it's actually the IRS Code 264. And what it talks about certain amounts paid in connection with insurance contracts. Now, if you've actually taken the time, like I have, to sit down and read this code, it'll talk to you about what can be deducted and what is not deducted in an insurance policy on someone's taxes. Of course, on a personal level, you wouldn't be able to deduct it anyway.
Okay.
However, on a corporate level, there are some exemptions to the rule.
Wow.
Yes.
Okay.
It's a straight fact. Things like key man policies, things like buy-sell agreements, etc., if structured properly. I say the word structured very, very carefully because it's true. If structured properly can lead to many benefits to the actual business owner, to the actual corporation, and it can reduce their tax liability overall.
So what you're saying is not only I can have a buy-sell agreement, which happens all the time. For those that don't know, if we're running a business together, I pass away, he doesn't want to deal with my wife, or maybe I don't want to deal with his spouse. So what happens is a policy is put in place where if I pass away, that I'm bought out, my wife's taken care of, and then he gets to run the business and fill in the holes that I left when I left the job. I got hit by a meteor, who knows? But
Lightning bolt.
yeah, whatever does happen, he's going to know as a business owner that even though he has a partner in me, he can't control what I do in life. As long as the policy is placed, everything is safe. Now, with that being said, since there's a cash value, we can also build a retirement account and have tax benefits because of this program, which is
absolutely
fantastic.
Absolutely. So I actually have an example of such. So I know many people have heard the terms of buy-sell agreements, executive bonus strategies, and it's in your little pamphlets when you pull stuff from your insurance carriers as you're learning and you come into the insurance field. They send you there's that little section in your little portal that talks about that, right?
Sure.
But how many people really know how to use it?
Most don't.
Most don't.
I learned a couple of things. I was familiar with this, but I learned a couple of ththings just talking about these tax codes that I didn't even know about.
Yeah.
So even myself, we can all probably use a little more information on this.
I agree. And it's important information to know because you've got a lot of controversy inside of insurance where people have different perspectives because of what they're taught. They don't have necessarily the, I guess, unbiased opinion generally. You've got certain companies that talk about, buy term and invest the difference,
Sure.
where you're self-insured at that point.
Sure.
And so and that's been a very common concept that's been thrown around the market lately. And what we've also come to find out is then that leads agents to think that I can't talk to wealthy people or business owners because they're self-insured. They're rich. They don't need insurance policies anymore. Well, that's actually where the rest of the strategies are not talked about come into play, because you actually can target that demographic of clients and utilize and structure the insurance policies properly to where they can actually say, okay, great, I've got this, I can maximize its benefits and what it's intended to do, and I get a little bonus, which is deducting it off my taxes or writing it off, however the company's structured. So one of my clients actually was the owner of, and he still is the owner, I should say, not was, is the owner of a plumbing business. And he actually is a C Corp structured business. Now, I understand there's a lot of different ways to structure a business. In this particular example, we're only going to talk about C corporations because it's the easiest example to explain everything to. This can be very detailed. It can be very complicated. And if you don't know what you're doing, please seek help. Don't try and go out and do this alone.
Yes.
Because you have to have conversations with the CPA, with the bookkeeper if they have it, or their whole accounting team and their CFO in order to do this right. Everyone's got to be on board. And if you're not prepared to pitch this, don't go walking around and trying to do this right.
Absolutely, 100%.
The example here is the C Corp. It was a C Corp structured business that had a gross $1.9 million annually. And what it did, the business was very simple, actually. Plumbing and heating and air conditioning. I mean, sounds like a very reasonable business.
And people hear 1.9 million, they think it's a lot of money.
They do.
A lot of reasons why we're having this is we're showing people that not only how to have complex conversations in a very simple way. What I mean is talk about what you know. We're going to give you enough information where you'll be able to, mention, hey, you own a business. There's a lot of tax benefits you may not be open to. And that's where the conversation stops.
Correct.
And the more you understand these things, the more you can say, you can have a conversation with someone like Jesse and let them know what's going on. Now, for a business, this is another reason. People hear $1.9 million. That is not a big number when it comes to running a business. It is very easy for revenue to get that and even higher. So don't think you have to see this very huge, elaborate business. There's a lot of business owners that you may know right now that are even in their startup phase that have a lot of revenue coming through that they need these benefits. So I'll let you keep going.
They do. So the client, when he was pitched to me, it was actually a referral from an Aflac agent. When the client was pitched to me, this client was actually interested, generally speaking, to reduce their tax liability because their bookkeeper had disclosed to me that after a certain point, once they pass $2 million, they're in a completely different tax setting. So they want to try and keep the income below $2 million. So that was one of the things that he was also interested in. But the client also wanted an exit strategy so he can kind of retire from his business. The client was 49 years old, approaching 50. And when he came to me, he said, you know what, I actually want to retire. We already got our retirement account set up. I actually proposed, and I'm going to talk about this in a minute, how an insurance policy could supplement his retirement even through his business as a business passes money through the actual insurance policy. The client also wanted to take care of himself and his wife. Being that he was CEO and his wife was COO, and this was, a family-ran business for the most part, he wanted to make sure that if something happens to her, one of his biggest assets, which was his COO, isn't going and gone, and now all of a sudden his business runs apart. He disclosed to me, actually, he said, she's the backbone of my business, so I can't do anything about it.
So this is a husband and wife business.
Very much so. Okay. They do have a management team. They do have, they've got their stuff sorted out.
So it's funny how they have a management team and you were still able to help them out.
Yes, absolutely.
Wow. So, a lot of people would say, I have to speak to my associate. I already have someone for that. This person had a team for that, and just he was still able to help this business out.
Correct. And it's because I was able to actually assist them. And it's because I was able to actually assist them with a few things that they didn't realize. See, even though they had a management team in place and the management team knew certain things, we were able to actually talk to them and go, hey, you know what? I can actually help you with this side of it. They were curious. They asked more questions. We actually sat down and put heads together, and they realized, yes, this can actually be done. So we were actually able to structure an insurance policy for the business to help reduce the tax liability on the premiums they're paying into the actual policy, that policy growing cash value for their retirement, and also having life insurance and living benefits along overall in case something happened to the actual owners of the policy.
So we're able to protect, God forbid, if someone passes away, the business is going to be just fine.
Yes.
We're able to lower the income because this is all of a write-off.
Correct.
And at the same point, have a little retirement for ourselves with all the cash value.
Yes, sir.
Fantastic. Okay, well, I want to see what happens next.
So here's actually the illustration I used for that client. We actually went ahead and put up $1 million policy. Now this $1 million, as most of you are familiar with, living benefits, has a living benefit attached to it and also has a death benefit. Death benefit paying out when someone passes away, living benefit paying out in life, correct? It's also got an annual premium of $20,000. Okay, now, so a lot of insurance agents, you know what that means to your checking account, right? But I'm not talking about that today. It is an annual premium of $20,000, and over here, the cash value at the age of 66, if you maintain that target premium, would have been $482,000 for him to help him supplement his retirement. Now, I'm not going to get into all the details of how it works, but I'm definitely going to run over some brief understanding of why we did it this way. We want enough deductions on the tax side to make it worth his time. We also want enough death benefit to cover them in the event something were to happen, life or in death. And we also are not trying to replace their retirement income. So let's not try to replace anybody's current strategies for retirement. This is only intended to be a supplement, not intended to be a replacement strategy for retirement.
Wonderful.
So this is actually going to come out tax-free, or tax advantage, as we call it, because you're able to pull the money out. If you're able to pull the money out correctly, you're able to get it out without having to pay taxes. The next illustration was for the one for his wife. Let's move to the next slide. Again, another $1 million, a $15,000 annual total premium with a cash value at the age of 67 at $512,000.
You know, for the client, because of the tax benefit, I mean, this isn't even they're not even paying you anything. It's money that would have went to Uncle Sam that's going to you anyways, right? So I think when people see these big premiums, like, wow, how do people afford this? But this is almost, I don't want to say free money, but this would have been money that would have went somewhere else.
Correct. You actually will end up being able to actually take off your taxes a little bit more than you would have by paying this, as opposed to paying Uncle Sam.
Wow.
So it does greatly benefit the client. That's why so many businesses look for deductions and write-offs. That's why when I come out here and I decided to rent an exotic car, it's because I want a deduction or a write-off. Mm-hmm. Just kidding. That was all a joke. I don't do that. Yeah, I do. Anyway, so but now a lot of people, there's going to be controversy on this because people come to me and say, well, you know what? You can't deduct all that. You can't write all that. It's a big amount. Isn't the IRS going to draw some red flags? And this is true to an extent. What you can deduct, and I'll show you on the next slide, is most of these universal life policies have what we call cost ledgers. Now, under the IRS guideline of 264, it'll stipulate and state that the only thing deductible for a business is going to be the cost of the actual insurance. Mm-hmm. That is black and white. You're able to deduct that if your business is structured correctly. Okay? So you have to refer to this page, so you're actually only able to deduct so much in premiums. All right? However, I did devise a way to allow the rest of it to also come off the corporate taxes as well, too.
Fantastic.
Yes, but that's a little complicated. We're not going to get into this video because it's something that has to be done on a case-by-case basis, but it can be done.
I mean, we can make this video as complex as we want. Again, we want to bring home the important thing is the people that you're talking to, especially business owners, there's ways of, they're not buying life insurance, okay? Do they want to give the money to the IRS? It's completely up to them. But there's a lot of problems to be solved in businesses, and not only we can put the money to solve it, but we can use it as a way that it's a tax deductions. And I think Jesse did a fantastic job, and he's been working with a lot of our agents who've been asking help for insurance 401. I mean, he just wrote a $33,000 premium just 2 days ago, right? So, I mean, you know, this is something where you don't have to be with us to ask Jesse questions. He's part of the gang. You know, we're always here to help any way we can, and he's no different. If you ever want some more information, if you ever have questions, you're in front of a client, you know they have a business, you know there's some sort of need, but you have no idea what to do, he's a perfect man to talk to. You know, I think people are going to get a real kick out of this. Jesse, thank you so much for being on the video. You did fantastic. Yes, and tune in again. We'll be doing this. Who knows what we'll be doing next, but this is not something that you get anywhere else. We can agree on that, right?